Mortgage life insurance. Mortgage life insurance means is an insurance on your life during the amortization period, and the benefit is payable to your family, to the lender. I'll repeat it again. Mortgage life insurance means insurance on your life during the amortization period, and the benefit is paid back to the lender. Lender, not your family. So in other words, when you want to get a mortgage, there are a couple of insurance that is attached to your mortgage. So let me give you some examples. One, if your down payment is less than 20%, it is compulsory that you get mortgage loan insurance or mortgage default insurance. Depending on the financial institution that you use for your mortgage, they might call it mortgage loan insurance or mortgage default insurance. And that type of insurance is compulsory if your down payment is less than 20%. So mortgage life insurance that I just talked about is different from mortgage loan insurance or mortgage default insurance. They are totally different, right? So there's another type of insurance that can be attached to your mortgage or offered, which we call home insurance. That is, should in case there's a natural disaster, the wall, the roof is affected, right? You can get some compensation from the home insurance. Or if you have a condo that you bought, that would be condo insurance. So, but this type of insurance that I'm talking about is called mortgage life insurance. It is very good. It doesn't help you to pay the mortgage when you are alive. It pays off the outstanding mortgage balance to the lender. God forbid you gain admission to heaven during the amortization period. Now, as good as this mortgage life insurance is, there's something better, right? There's an adage that says you can use one stone to kill two birds. Okay, so if you have your personal life insurance policy in Canada, you can actually use it as your mortgage life insurance. So what's the difference? For your personal life insurance policy, the benefit goes to your family or the beneficiaries that you put on that policy. And those beneficiaries, if they are living in the mortgage, they can use the money to pay off the mortgage, right? They can use to pay off the lender if there's an outstanding mortgage balance. But on your mortgage life insurance, which you get from a financial institution or from a mortgage broker, is good. It is just that that type of contract or that type of policy is designed in such a way that the benefit is paid to the mortgage lender. So $0 does not go to your family, $1 does not go to your family. So when I have discussions with people that want to buy their mortgage, I know you want to do some things that you don't talk to professionals, you just go straight to a financial institution and whatever they tell you, la, 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 you just get into it. I am here to actually educate you about this. You can use your personal life insurance as your mortgage life insurance policy. So the question is, who would you like to protect? Would you like to protect the mortgage lender or would you like to protect the family? Because you can actually use your personal life insurance as your mortgage life insurance policy. Okay. There is also this confusion. Let me say I have a life insurance from my employer. Let me say I have employer life insurance. That's okay, right? It's okay. It's actually good if you have an employer life insurance. But there are so many things that will happen to their policy. Is either the employer life insurance leave you alone or you are the one that will leave that policy with your employer because you actually resigned, you got another better offer, another job somewhere and you lost the benefit, right? Or if you are actually in a situation where you are able to convert your employer benefit to a personal plan, you can actually do that. But it might come with a extra cost because before you were with a group plan, now you want to change it to an individual plan. It's possible that when you want to convert it, the rate is higher because when you were under a group plan, there was group benefit, there was group discount. So when you want to transition into a personal policy because you have left the company, the employer life insurance, you want to transfer it to a personal policy, and that makes it an individual policy. It might. It all depends on the company that was used to set up the group employer life insurance. Okay. So the question now is, I'll repeat it again. Would you like to would you like to protect your lender or would you like to protect your family? So the decision is yours. My job is just to educate and enlighten you. If you have questions regarding mortgage life insurance versus your personal life insurance, I am able to guide you. Right? You you should remember this. It's good to do the right thing at the right time. Very important. It's always good to do the right thing at the right time. Now, the fantastic thing about buying a home, buying a property in Canada is people want to buy it when the rate is down. Oh, the rate, mortgage rate is down. That is when people want to buy. Right. Now, it also means the best time to set up your personal life insurance is when you are young, when you are healthy, when you're young. That is the best time to set up your life insurance because the cost of your life insurance at that particular point is affordable because you're young. So by the time you are getting much advanced in age, it becomes more expensive, right? It becomes more expensive because life insurance is not about priority. It is not about I will get it later. It is about the fact that life can happen at any point, and the best time to get your life insurance is now. No pressure. The most important thing is for us to talk about the fact that life happens. It could happen to anyone. Now, as human beings, I have seen people that have car insurance. Yes, it is good. It is actually compulsory to have a car insurance, but that car can be replaced. Your house has insurance, the house can be replaced. It is a human being that is alive that can live in a property, can drive a car. So your life is also valuable, and your most valuable asset is your life and the ability to work. Your most valuable asset is your life and the ability to work. So because you can work and earn an income, that is why you are able to buy a property, you can buy a car, and all of that. So, setting up your life insurance policy is also very, very important. Now, there's a school of thought actually that says you don't need life insurance as retirement. The way I like to say this, it all depends on the person that is advising you, right? If you are someone that you love to travel by airplane, you might not want to crawl like a tortoise, right? So if a tortoise wants to advise you, you might not be able to take that advice. So some people say it is not good to actually have life insurance because you don't need it, you don't have dependents. But I'm going to argue with that because there are three major things your personal life insurance can do for you at retirement. One, you are able to get compassionate benefit from your life insurance policy. Number two is that should in case, God forbid, you have a disability and you cannot work, you can actually get living benefit from some types of life insurance policy. And then the third benefit is that if it is a cash value life insurance, you can actually set up collateral loan, and that is an option for you to enjoy your policy when you are alive. So I hope you learned something today. Feel free to reach out to me if you have questions. Thank you.